Good day, folks. John Mackey here with Credit Genius and the Substack post. On the video you see here is J.S. Wardo with an H because I seem to constantly misspell it, and I apologize to her for that. But we're going to or we're going to go over some stuff today about underwriters because they're kind of the secret in the room. What do they do? Are they hiding off in a corner, just lurking, waiting to attack? What's their job? An underwriter's job is to make sure that the loan is approvable and acceptable, especially when you go forward to what I understand are the uh, purchasers of the loans. And rather than get myself into trouble and keep on babbling here, I'm going to introduce J.S. Porto. J.S., how are you?
I'm good, John. How are you today?
Good, thank you.
Happy to
Thank
be
you.
here.
Oh, good. Like I said in the introduction, it's sometimes it's confusing because everybody tries to please the loan officer. The loan officer goes to the individual and says, "I need this, this, and this." But in a nutshell, what does a mortgage underwriter do? Um, and what don't they do?
Okay,
What do you want them to know about your job?
the mortgage underwriter is the person behind the scenes that you'll never talk to the underwriter. The underwriter is truly behind the scenes. The underwriter will talk to the loan processor, the loan officer for absolute. They will not talk to the realtors. They will not talk to anybody else in the transaction.
Why is that?
They're behind the scenes for a reason. One, they are protected. They're protected because way back in the day, it got a little scary with consumers deciding that underwriters were out to get them when they were told no, they didn't get a mortgage. The first thing that happened is they put us behind locked doors. And I'm sure there are some very small banks out there that still let the underwriters kind of be in the open, but the majority of people don't. You either are behind a door with a lock key, or the majority of them work from home now. Most of the time, you won't even know their name. And really, you shouldn't. It's for their own protection. Because we are the bearer of bad news, or we could be perceived as the bearer of bad news, or the bearer of give me more information. I'm tired of those questions, and the anxiety boils up. They do really need to stay protected. We are the people who ultimately make the loan decision. When your loan officer or your loan processor is asking you for documentation or explanations for whatever, they're ultimately putting it in a package. Now it's delivered through, e-delivery, so it's coming to you in computer systems, and they're the ones that have to review all the documentation to one, make sure your borrower qualifies, but two, make sure that that loan itself, the entire package, meets agency requirement, whoever that agency might be, whether it's Fannie, Freddie, government, specific lender products, we call those portfolio products, could be USDA, could be VA. Whoever the agency is, the underwriter has to make sure that one, they have all the required documentation, they have everything to support that the borrower is truly qualified for that loan because there are so many rules that change often, and then they put their name on it. So now that person is the underwriter who is now responsible for the loan. So let's say and what I mean by that is let's say the underwriter says, yes, we've done it, we've got everything we need. Your loan is approved and you go all the way through and you buy your home, but then something happens and maybe you have a catastrophe, a medical catastrophe, and you can't make the payment. What I can tell you is the very first thing that will happen is that loan will be audited. And if all the documentation does not fit all these rules, or if things can't be supported, like income that the underwriter used to validate the loan qualification, it comes back on that person,
On the underwriter.
the underwriter. And that means that whoever you're employed with could then have to buy that loan back. It also means that
Huh.
when you're working on a particular loan where you are certified through a government agency that you are experienced enough, you are qualified to be underwriting these loans, it's like a ding against you.
Oh,
They,
pardon me.
you're fine. They literally track your underwriting record. So if I can't do my job correctly as an underwriter, I could lose my certification, is what that comes down to.
And that certification allows you to be an
Underwrite.
underwriter.
Exactly. And all underwriters don't underwrite every single agency and or every single product. I happen to be one that did. But you have to get certified to do that. It takes a many, many years. So, it's an important role because you want to do the job correctly, but you also have to understand the agency's goals. And I think that's important. When I used to train underwriters, that was where I would always start. Let's understand the agency's goals. Because if you can understand the goal of the agency, you can understand where the rules come from better.
Can you explain the difference between Fannie Mae and Freddie Mac?
Mhm. They are two separate agencies, very, very similar. They are our main conventional lenders, and they buy the pools of the conventional loans. But they do have some differences. So basically, they have little tweaks to their qualifications versus each other. So there is a purpose for both. A lot of people might just say, okay, well, they're two entities doing the exact same thing, but that's not completely true. They have different products and they have different tweaks to different rules. Where one is maybe a little bit more lenient on one side, the other is could be more lenient on something different over here. So the whole point of them was to kind of cover all bases per se, if they could. FHA covers its base, VA covers its base, USDA covers its base, and then you have Fannie and Freddie.
Who underwrites FHA?
An FHA certified underwriter. They have to be qualified, they have to go through training, and same with VA. Same with VA. You have to go through test cases for both and get certification.
Okay, because I was under the assumption that FHA went to like Fannie Mae or Freddie Mac and conventional went the other.
Conventional goes Fannie, Freddie.
Okay,
FHA is FHA, it's government. VA is also government, but obviously geared specifically and only for veterans or
right.
widows of veterans. And then USDA is similar product to FHA, only it is meant for rural, for agriculture.
The agricultural land or
It's
homes
homes.
on agricultural land.
Yes, it's homes. It's not a farmland. It's not like the farm loans. It's literally a home loan, but it's more for out rural. Very,
Okay,
very different rules from FHA. They're much stricter, honestly. They're much stricter.
USDA is.
Yes. And the reason for that is because technically they really are they're a riskier loan.
And
If
why is that?
Well, most of the time when you are getting a rural loan, there is a farm involved. Even though it's not a farm loan, most of the time there is a farm involved. That's a very, very difficult line of work. It's a very difficult line to make your living. So they are riskier loans. Also, if you live in the city like most people do, going and living 100 miles out and commuting in is not the most ideal. So if something were to happen and the USDA insured that loan and they now have to resell that property due to foreclosure, their
Right.
market's not as big.
Yeah, yeah, that's That's so true. Um, okay, so a loan officer takes an application. I believe
Mhm.
it's called a 1003.
Exactly.
And that 1003, they send it through what they call DU or direct underwriting, or I believe
Or
that's the acronym.
yeah, DU, that is direct underwriting, or LP, which is Freddie Mac's version of DU.
Oh, is that what it is?
Yeah, they're
Okay.
they're very similar. Obviously, they each have their own little, tweaks. But if FHA can be run through either of them. So it doesn't really matter which one you're going to get. Most of the time, lenders have a preferred one, and it comes down to the cost of it, whatever contract they manage to get. Some of them may prefer to run it through LP, some of them may run it through DU. Majority run it through DU.
Okay. And that DU will then indicate whether, first of all, the credit score meets the requirements.
Correct?
Have they verified the income at that point?
No, the DU, and DU is, this is the way DU will always be. DU can not necessarily validate income. They're taking steps towards that, but it really comes down to the strength of the overall loan. DU can only tell you a loan underwriting disposition based on the data that's put into it. And that's the key. And a human enters this data.
Okay.
So the DU can give you a preliminary answer based on the data that's input into the computer system.
So when an individual gets a pre-approved,
Mhm.
that's DU underwritten then?
Most, that's technically the rule now. They have to run it through the pre-approval. There'll be some verbiage in it that says it hasn't been fully underwritten, but based on this data, this person is pre-approved for a mortgage. Yes. They have
Okay,
run
which
it through
is,
the U.
I know we're going a little bit off topic, but
It's okay.
we've got pre-approval and pre-qualified. Pre-qualified used to be the old way. As a realtor, we'd go and say, okay, my buyer is pre-qualified. That means nothing. It just
Mm-mm.
means based on what I've heard as a loan officer,
Yeah, and they don't
that
use
person,
that. They don't use that very much anymore. People now
I understand
want,
that because there was so much
exactly.
ridiculousness in it.
Exactly. So now they want those pre-approval letters. Like most realtors won't even make an offer on a home without a pre-approval letter. They have
Right.
your loan officer's name and phone number, and they've spoken directly with them.
Right. Okay.
Now,
So
at this
you know,
point, an underwriter hasn't seen anything.
at that point, they haven't. They
Have
have
not.
to submit that loan
Mhm.
based on the information that they've collected. And they're going to try to collect as much information as possible before submitting it to you, or they should collect all of it prior to.
They should collect the bare minimums of what they need. I wrote an article about be prepared to give your pay stubs, your W-2s, your bank statements. Those are the basics. And an underwriter can tell you yes or no with just that documentation. They can say, yeah, everything looks good. I need more, or everything looks good. Now go find that home. And when you find that home, the underwriter will then underwrite that home.
Based on the PITI and the
And not
DTI.
just, yeah, not just the debt to income ratio, but also the property itself.
Okay.
An underwriter has to also approve the property.
Okay. And you would do that through the appraisal
And title report, those two documents, yes.
and what?
Title report.
Title report.
Yes. So we as an underwriter not only says yes or no to the applicant, the consumer, but also to the property and the title history. If we can't get clear title, while the underwriter is not the person to work on getting that clear title, that's the title company, we still have to approve the title. We have to make sure that there are no liens out there, that there are no shared driveways without a maintenance agreement. That's just an easy little example. That if there are past due taxes, that the title company already has it in the plans to collect those from the seller. Or are there any personal liens out there against our buyer? Those show up on title reports as well.
Against the
And
buyer.
against the buyer, yes, those can show up in many states. In many states, especially on the East Coast, they also have to have attorneys because a lot of things can show up. It's pretty amazing what can show up.
I know. I've heard horror stories about that, where I had to supply an affidavit that this particular item, it wasn't the individual's.
Right,
You know,
exactly.
they had the
Exactly.
wrong information.
And you have to understand that the title company insures that title.
Correct.
So when a person buys a property and they have to pay for title insurance, they call it a lender's alta. It's literally to make sure that the title company did all their work. Everything showed up on that paperwork, so the underwriter knew everything as well. And if something creeps up after the loan closes, that title insurance would fight that battle, not the lender, not the consumer.
Right. Okay. Okay.
And as far as the appraisal, underwriters are not appraisers, but they have to know appraisal rules.
Right.
And so they don't go out and look at the property. They lean on the appraiser to go out and appraise that property, tell them everything about it, and then show them comps that support the value. Because a loan cannot be made, you have to remember a home loan is a secured loan. If the property is not worth what we say it is, then if something were to happen, the lender couldn't go sell that home and still make their money to cover that loan. It's a secured loan. So the appraisal has to be reviewed by an underwriter, and lots of questions come out then. Unfortunately, a lot of issues come out then. Depending on the different type of loan you're getting, there are different rules.
Mm-hmm.
And I'll just give you a quick, easy example. FHA is very, very critical of health and safety rules. So you have a house and there are 4 steps going up to the front door. A conventional loan would say, cool, there are 4 steps going up to the front door. An FHA loan would say, is there a handrail? You must have a handrail. Health and safety. So those are just little tweaks and little differences that underwriters have to know, and they have to make sure that the property meets the required, well, all of the requirements of the particular agency, which again, agency means the type of loan you're getting.
Now, some cities have city codes
Absolutely.
that
Actually,
that
most do.
huh? Go
Most
ahead.
do. Most have lots of codes. City codes, county codes, there's lots of them.
I'm talking about upon a resale, that property must be inspected by a licensed inspector, and here's what you need to get a certificate from that person. Are you going to get that then and review that?
The appraiser will tell me whether or not everything is legal and up to code. So it's
Okay.
up to the appraiser to know these things. And it's up
Okay.
to the appraiser to tell me that very specifically.
Okay. So now you get a file.
Mhm.
You open it up and what do you look at first?
Very first thing I look at as an underwriter, every underwriter has their own little way of doing it. Very first thing I look at as an underwriter is I look at the application.
The 1003?
The 1003. I want to see what is the story that you are telling me. How many borrowers am I dealing with? And what are we doing? Are we buying a primary residence, a second home, an investment property? What do my borrowers do? Where do they live? How much money do they have? How much debt are we already looking at? How many investment properties do they own? Are they self-employed or do they work for someone? All of the basics are on that 1003. And the consumer signs that. So that's an important documentation for me, or document for me. The other thing I'm going to look at is one of the very last things, which are called declarations. And it's on the 1003.
That's
And
the
it,
page three.
yeah, and it tells me exactly, it tells me if they have had bankruptcy. Do they owe child support? Um, are they a first-time home buyer? It tells me things like that. So I always want to look at that because now what I've done is I've painted a picture in my mind. Okay, now I know what we're going to be looking at, who my customer is, and what am I going to be looking for specifically. So the first thing is the 1003. It gives me an overview.
Now, in the field that I'm in, there's a lot of people that had bankruptcies.
Hmm.
But there's a separate organization that goes out. Bankruptcy court typically is federal, and they don't, is a federal court, and they don't send that report to the credit bureau. A credit bureau, a fourth credit bureau comes in and will search the court records. And then
Hmm.
if they find bankruptcy, they'll put it on the credit report. So you
Yeah,
would see that based on the credit report. But
correct.
what happens if it's not there and they declare it as on that page three, on those declarations, that they do not have one, but they do?
Okay, well, if I don't know about it, there's no way I can know about it. I mean, let's just be right up front with that, right?
Right.
Um, We get a lot of reports. So you've mentioned before that we get a tri-merge. We absolutely get the tri-merge, and we also get the reports that comes in and it gives us any site, any type of public records. Now, public records means more than just bankruptcy. Public records means a tax lien, an eviction,
Foreclosures.
foreclosures, any public record where something was filed. That shows up on the credit report. But where it also shows up is on the fraud report. Now, the fraud report has evolved over the years. It has evolved into a huge business. Used to be that fraud reports, we really didn't even have them. You know, I'm dating myself, but way back when in the 80s and early 90s, we didn't have fraud reports. We really relied on the credit bureaus and title reports. Now, there are companies out there that provide a full background of your borrower. The fraud report will show me anything that hasn't shown up anywhere else. This is where I could get erroneous employer. I could get erroneous address. I could get erroneous name, erroneous social security number. Any public record ever. I get a full record of any property owned at any time, even if they weren't on a mortgage, but they were just on title. Let's say somebody was on title as a backup for their elderly mother or whatever. I'm going to see it. The fraud reports delve so deep that is you're really not going to miss things these days.
I'm going to throw you a curveball. What happens in the declaration? It asks, if I remember correctly, are you a U.S. citizen? Do they
Yes.
have to be a U.S. citizen to purchase?
Absolutely not. Absolutely not. There are rules, very specific rules. So you could be a permanent resident,
Right.
you could be a non-permanent resident. And if you're a non-permanent resident, then we're just going to ask more questions. So, what type of visa are you here on? You know, are you here because you're a specialized engineer and let's say Intel sponsors you, then there are rules. So you've had to have been here for a certain number of years, and it has to be expected that you will continue to be here for you to buy a residence. And there are some visas that you can't buy a residence with. It's not stable enough that you're going to be here, and that can be a little difficult. I was We've gone up and down with DACA, which is a C-33, and a C-33 is where the parents came to this country and had a child, and the child is not considered a U.S. citizen, although we could get into the politics of all that, of the Declaration of Independence and blah, 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 but it's called DACA. And those children have now grown up.
Right.
Some of them have been able to become citizens, and some of them, it's a long and expensive process. They're still going to school, and maybe they're just starting their nursing careers, and they're paying their taxes, and they're doing everything right. But depending on how the wind blows with politics, I've been in this industry to watch DACA be, yes, you can buy a home. No, you can't. Yes, you can. No, you can't. So politics comes into agency rules too, and that's a heartbreaking fact. But the short answer is you do not have to be a US citizen, but there are rules around who is eligible and who is not. Comes down to the visa.
Okay. Have you ever overridden a DU?
Oh, I've overridden DUs many times.
You have.
DUs, yeah, DUs are not the everything. DUs can't know every single thing. When not every lender will allow a DU to be overridden, but a good lender has experienced underwriters who really do know a good loan when they see a good loan and a good borrower when they see a good borrower. DU is not always correct.
Can you give me an example of when that might happen?
Sure, it can happen when it happens with FHA all the time, just so you know. It's called a manual underwrite. There are
Right.
rules where you 100% have to just downgrade that DU, put it aside, and now you are manually underwriting that loan. That is extremely common. It's also very common on a VA because let me give you an example for FHA. FHA, you have a borrower who filed a BK, a specific 13, not a 7, but a 13. So
Okay,
it's
so
a
making payments.
workout plan, exactly. And they're automatically going to be either downgraded, the underwriter has to downgrade it, push the DU aside, or the DU does it itself and says it's a refer. You can go and manually underwrite that borrower. You're going to document that they've had this BK for over a year. They've been making all their payments. They've done every single thing they're supposed to do according to the court's orders for the workout plan, and they get the court's approval. So they'll have a
Ah,
trustee. They have an assigned trustee with the courts. That
correct.
trustee has to say, yes, they're in a good place. They've worked hard. They're doing everything right. They are approved to use this money to go buy a house. And then the underwriter will manually underwrite them, make sure they meet all DTI requirements, their income is stable, they've been doing everything they said they would on their credit, they have the funds, they're allowable funds, that's the other key, and then they can approve the loan.
But if you file a bankruptcy, Chapter 13, and it's on the credit report, it's going to negatively reflect on the score. So that
Absolutely.
means, though, that your score would still have to be within the parameters that you're going to accept.
It is absolutely correct. But John, you would be amazed at how many people file bankruptcy before it gets that bad. Before it gets so bad that their credit score is just wrecked. It's gone. It's just bankruptcy is a protection. It stops it. And
Right.
literally, so you are now making your payments. The creditors are all working together with the courts, and it doesn't take long for you to get to the point where that credit score is just good enough. That's all it takes.
And most of them would probably be FHA or
Mm,
maybe VA.
100%. 100%.
It wouldn't be conventional because the time period is too long.
Yeah, the time period conventional requires that it be finished.
Say, 5 years,
They have to be finished. So they have to be finished paying off all that debt.
5 years on that. Typically on a Chapter
Yeah,
13,
I mean,
5 years.
I see 3 years, I see
You
five
do,
years, They just
but
have to,
no,
it has to be,
I'm
it
sorry.
has to be done.
Okay, well that's interesting. That's interesting. What mortgage myth have you heard of that simply isn't true?
That you have to have perfect credit, to get a mortgage. That's one of the most common mortgage myths. That's not true at all. You don't. Matter of fact, very few people are. So it's a huge myth. I've literally done loans where people's, they've had life and they've had life and stuff has happened and their score is just barely there. And if you just look at it on paper, it's like, well, this is not a good credit risk, but that's not how it works. You have to look at the age of these credit lines. You have to understand what happened. Here's a real big thing that an underwriter wants to know.
Mhm.
Was this out of your control?
Ah,
Because
medical debt would fit into that.
medical debt will fit into that. Another one is divorce does not, by the way. A lot of people think they can come into a lender and say, well, I went through this divorce and my ex did this and my ex did this. And the underwriter is going to say, but see, that was a joint loan. So I'm sorry it happened to you. But that's not extenuating circumstances, and that's what we're looking for, extenuating circumstances. I had a borrower one time paint this gigantic picture for me, went way overboard. They didn't have to get as technical as they got. We don't want to know, medically what happened. You don't have to give us your medical records. But I had a borrower go as far as to tell me about how they had to step in to save their grandchild. Their own child was proving to not be a fit parent, and they had to go through court battles and they had to go through everything they had to go through because they loved their grandchild and wanted to save that person and protect that person. That's a decision, but that's an understandable decision. That could be extenuating circumstance, but don't get me wrong, they had to prove it. You could be a person who has a victim of fraud. That's extenuating circumstances. That's not your fault. But I do need to know that it is fraud. So did you file a police report? Show that to me. I can then override what I'm seeing because I have facts in front of me. So extenuating circumstances come into play, but I need documentation. I need a letter. Just tell me the truth. And then let's see if we can prove this so that I can move forward. But even if you don't have anything catastrophic and you just have some dings like most humans do, you're still not disqualified. You know, it could be as simple as your credit score is lower, but it's not horrendous, and you did have a late. Tell me what happened. You went on vacation, completely forgot about that bill until you got a phone call, and oh my gosh, it was already 30 days late because you were on a cruise and nobody could reach you. And that's life.
Sure.
So I think that's the biggest mistake people make is they think that he'll have to have perfect credit to buy a home, and it's not true.
Yeah, that's so true. When I was in real estate and I was doing assumptions with no qualify, the first thing I would try to do was to see if they had misinformation about where they stood. Some people get a late payment and they decide that their credit is bad and they think I'm not going to qualify. And it was a year and a half ago, something
Right,
like that. Well,
right.
then we take a look at a credit report and we say, no, you're good to go. There's no point in assuming when you can open up the entire market to them. Um,
Exactly. And agencies have gotten better and better at that, at saying they've set very specific rules. You can have so many lates within the last 24 months on a revolving, and you can have so many lates on an installment in the last 24 months and 12 months on an installment. So many lates on a mortgage in the last 12 months and 24 months. And it still can be overridden by the underwriter.
and that
So
was the old way of doing it prior to
it
credit scoring.
used to be all manual, used to be all manual. Exactly. Well, it's still there. It's just that we don't have to use it as often.
I see. Okay. Now to throw a kind of a monkey wrench into this and to really get into some great stuff, some meaty stuff. What's wrong with the underwriting system? What do you see that if you could fix?
I think as an insider, what I would fix is the political up and downs. Okay, because, and what I mean by that is the temperature changes all the times at these agencies. I mean, we've just seen it. A new president comes in and he throws somebody who has really no reason to be there as the head of HUD. HUD's FHA. And this person can look at it and say, hey, man, we need to be giving out more loans. Loosen all the rules. Well, that's not fair. Or just the opposite. Tighten all these rules. That's not fair. People work a long time towards home ownership and they try to figure out the rules and they try to figure out what they need to do to get that loan. And then all of a sudden, because a new political party's in control, rules start changing. That's not right. Underwriters don't have any control of that. The agencies do have to ask for input from, the industry, but that doesn't mean underwriters. That means the higher ups in the industry, the heads of the banks and the heads of, the big lenders. I wish that didn't happen as often as it happens. And it could happen really fast and you have no warning. FHA got a little bit better about that. They change a rule and say applications taken after this date. That was nice because for a while you could literally have applied and an underwriter said, okay, you're good. And the next day the rule changed and the underwriter had to come back and say that we literally had to go and audit all our files and say, now you're not good. And
Right.
that's not fair. That's not fair to anybody, the consumer or the underwriter. The lenders, that's just not right. So that's something I would really want to change. I would want to change that system.
Okay, that makes sense.
I think rules do change for good reasons, and when they do, great. But when it's floating with political ambitions, that's not when it's fair. It's just
Okay.
not.
Okay. At this point, I want to wrap this up.
Absolutely.
And you've given us a tremendous amount of information. And I know that through the mortgages that I did and the real estate that I did, you're a genius.
Oh,
And
thank you.
I love that. Because we could talk all day about this, and we have, not all day, but
Yeah, we
we've
we tend to
talked a
get
lot.
we do. We tend to get wrapped up in it. We definitely do.
And for me, I just go down rabbit holes. So that's always fun. Um, what, how do you want to end this? What do you want people to understand?
I want people to understand that it's not as dire as it feels. We have entire generations out there saying, I'm never going to own. And I understand that a lot of that comes from the fact that they feel like they can't afford life as it is. But there are some of us out here that want to, one, arm you with information, such as my Substack. Arm you with information. I want you to know what we're looking at, why we're looking at it. But as I continue writing, I'm going to start going into things like grants and housing loans that are meant to give you those funds to get you in a house. There are ways.
Right,
Maybe we have to do a little work on your credit beforehand. Maybe you need to
right,
be on that job a little longer, but there are ways to do this. It's not as dire, and that's the information I want to get out there. I want to get the honest information. I'm not selling a loan. I want to hand you information.
100%,
That's what I want
100%,
to do.
100%. And that's the thing with me too. I'm not selling anything. Maybe a
Right.
book or two or something, but all both of us are trying to do. What attracted me to you, um, is the desire to get out there and get the truth told. Because once people have the truth, they can start standing up and knowing what their rights are. And
Exactly.
this is where I come from. I know this is where you come from.
Yes.
And I think it's exceedingly important in this day and age of lies and deceit.
Yes.
It's good to know what the truth is. And so, how do people know what the truth is? Well, listen to us. We'll tell you.
Yeah, we're
At
going to tell
least,
you the truth
at least from the perspective of underwriting and credit.
from what we know, our expertise. Exactly.
Yeah. Well,
Well, and I
thank
hope
you.
people ask questions. I'd like to invite people to ask questions as well. They can do comments, they can send direct messages to either of us. We will, I know we both are in the same boat. We will answer your questions always.
Right. Exactly. Thank you very much,
You're welcome.
JS. Sorry
You're
about that.
welcome.
I
That's
got the
okay.
last name right. Now where I was going with that was J.R. Ewing.
Oh, how funny. How funny. Wasn't that Dallas?
Yes.
I
Ah,
love
what
it.
an idiot I am.
I
But
love
anyway, that's fun.
it.
Anyway,
Well,
thank you very much.
you're
We'll wrap
welcome.
this up and we'll see you another time.
Okay, have a great day.
Thanks.
Thanks. Bye.
Bye.